Hi everyone, I'm Lorenzo Di Mattia, manager of Hedge Invest, to build a macro fund. I wanted to tell you what we have done in March and the outlook for the next 3 or 4 months. March was a very bad month for us, unfortunately. We made a major mistake thinking that the lockdowns would be limited to China and would not be implemented outside China. This was a mistake we made back in February. As soon as we realized this mistake, we cut our long exposure by 2/3 and kept about 20% of the book, which was a relatively small exposure. However, the market not only declined in a fashion similar only to 1987, but it didn't even give the chance to sell with a bounce on a 200 moving average or anything like that. In fact, even in 1929, during the crash, the market actually bounced on the 200 moving average for a few days, which would have allowed us to cut further the remaining part of our book. Unfortunately, we were forced to liquidate that on a very big down day, and also with a market-wide trading halt, which exacerbated the downside, and we had very bad execution. So unfortunately, losses were a bit bigger than expected. As usual, our risk management imposes us to go to 100% cash when losses exceed certain amounts, which is what we did. And we then evaluated the situation objectively. We get a fresh look at the economy, earnings, and the outlook for the rest of the year, in particular next quarter and the third quarter. And our conclusion was that the recession that was triggered by the coronavirus still has to run its course. We do have a positive pattern in terms of reopening in the next couple of months. However, the default cycle in companies, especially small businesses, and the consumer shock still have to show in the numbers. And so we believe, like in '08 or in other circumstances in previous recessions, there is a trigger, there is a reason, and then after that, even after the trigger disappears, there are second round effect, permanent damage that has to run its course. So we believe the market will have to digest this negative news. Now it's focused on the peak in coronavirus cases, but that's not the whole story. So we've been waiting mostly in cash to participate to the upside. And actually, if the market keeps rallying further, we actually plan to short at certain levels, because we really believe that the damage has not been priced yet, especially the default cycle and the damage to the consumer. The recovery will be basically a mix between a U and an L. It will not be a V-shaped recovery. We believe the first part of the recovery will be similar to a U, but then it will slow because the ability by the consumer to spend again will be constrained. The consumer is crippled. Unemployment is higher than in 2008 at the worst levels. It's similar to the 30s and will increase further. The consumer will not be willing to spend, even in the bullish case where most people find their job again by next year, which is unlikely. But even if that happens, the spending, the willingness and the ability to spend as much as before will not be there. The same is valid for companies' balance sheet. Balance sheet was very stretched prior to this, and the absence of revenues for several months will really put a lot of companies in distress situation. They will have to rebuild their balance sheet. This translates in laying off further, cutting capex, and in many cases bankruptcies. So we see a range in the S&P between 2,400 and 3,000, and we would think it would be a lot lower if it wasn't for the stimulus, because the valuation of the S&P, given what the earning path seems to be, which is that the S&P might make actually half of the earnings it made last year. So from 165, we could easily go to 80, $85 this year. And then to get back to what we made last year, it might take at least 2 or 3 years, maybe 4. So the market will be disappointed by the rate of growth from next year, and this might not come out right now, but it might be, a little more clear by the summer. So we plan to exploit both the long and the short side. Right now, it seems that if the market gets close to 3,000 with the S&P, there is a shorting opportunity. And then if the market is low enough at some point to price in all the negatives that will come out in the next 3 or 4 months, we will be ready to buy, especially the cyclical stocks, which are completely depressed already and will probably go down more. Thank you very much.